Remember when every financial advisor, every builder, and every cheerful media personality told you that the American housing boom was built on solid fundamentals? They told you that low inventory, high demand, and the unstoppable march of inflation meant prices could only ever go up. They called 2025 the return to normalcy, a soft landing where prices would gently stabilize and affordability would finally creep back. They were wrong. What we witnessed as 2025 staggered to its close was not a soft landing. It was a chaotic, painful, and ultimately necessary hard reset. Across the nation, we watched the housing map of American prosperity be violently redrawn, marked by the deep red scars of overvaluation and regret. The transcript you just analyzed, detailing the collapses in Phoenix, Boise, and Denver, wasn't just a grim report. It was a testament to the illusion that blinded millions of prospective homeowners and investors. The bubble didn't pop, it deflated slowly and painfully, suffocating entire metropolitan economies built on hype, cheap credit, and the toxic cocktail of FOMO. But here is the critical pivot, the moment we separate the financially doomed from the financially destined. The collapse of the old boom has cleared the ground for the most significant real estate opportunity of our generation. For the first time in nearly 2 decades, leverage is shifting away from desperate sellers and back into the hands of patient, informed buyers. As we enter 2026, the question is no longer where the crash is happening. The question is, where do you strike next? Where is the next cycle of realistic, sustainable growth already being planted, waiting for the patient, prepared buyer to seize it before the market realizes its mistake and prices explode again? This video is not about fear. It is about forensic analysis and tactical advantage. We are going to filter out the noise and the panic to identify the only 3 cities where the financial dynamics, demographic shifts, and policy trends align perfectly to deliver explosive yet sustainable growth starting this year. But to understand where to buy, you must first understand why everyone else is still losing. The great deception of 2025 was rooted in a fundamental misreading of the American consumer. Experts measured housing demand by the number of people who wanted to buy. We are measuring it by the number of people who can qualify, sustain the debt, and survive the punishing costs of ownership, namely property taxes and insurance. When mortgage rates stubbornly locked themselves above 7% for the bulk of 2025, they didn't just sideline first-time buyers. They turned millions of middle-class Americans into financial ghosts, visible in the data as demand, but invisible to lenders as qualified buyers. This single factor, coupled with the astronomical rise in homeowner insurance premiums across the South and West, often soaring by 50 to 150% in 2 years, created an equation that mathematically broke the American middle class. Take Tampa, for example, a city we previously saw struggling. The median household income could not absorb a 7.5% mortgage rate, plus property taxes, plus an annual $6,000 insurance premium. The dream became a liability. The market froze solid. This is why the soft landing failed. The system was built on the assumption of infinite liquidity and stable costs, neither of which exist anymore. But here's the good news, the crucial realization that unlocks the 2026 opportunity. The markets that crash the hardest are exactly where opportunity is not. They're saturated with inventory, haunted by overconfident investors who are still liquidating at a loss, and often tied to local job markets like tech in Denver or hospitality in Las Vegas that have proven fragile and susceptible to layoffs. We must look away from the wreckage and towards the unassuming, fundamentally strong, and recently overlooked cities that possess 3 distinct, crucial characteristics for the 2026 boom: job market resilience, uninflated costs of ownership, and municipal incentives for growth. You may have heard the standard advice, buy near hospitals and universities. That advice is outdated and insufficient. In the post-pandemic, post-rate hike economy, resilience means being diversified beyond tech and tourism. It means having an industrial backbone that can withstand cyclical downturns. Uninflated costs mean that the local government hasn't leveraged property owners into oblivion to fund unsustainable city growth, and that the area is not crippled by skyrocketing, uninsurable climate risk. Municipal incentives mean local governments are actively working to attract primary residents and stable businesses, not short-term rental speculators. The three cities we are about to unveil check all these boxes, and they all share one thing in common. They were overlooked during the 2020-2022 frenzy. They didn't have the flashy headlines of Phoenix or Boise, meaning their prices didn't surge 80% based on hype. They maintained a fundamental, sustainable relationship between local incomes and median home prices, and are now poised to see organic, explosive growth as the national correction pushes capital, people, and jobs out of the high-risk, high-volatility crash markets. The capital that fled Phoenix and Boise is looking for a new, safer home. It's looking for predictable returns, and it's heading to places that can still offer the core promise of the American dream: stability and a path to equity. The first city on our list has already begun its quiet ascent, driven by a trillion-dollar industrial renaissance that virtually nobody in the housing media is discussing. This isn't just a home purchase, it's an investment in the foundational economy of the new American century. Prepare to rethink everything you know about where value is created in this country. We are going deep, starting with a city that once represented the heart of the Rust Belt, now representing the heart of the new Opportunity Belt. The old narratives are dying. The new money is flowing. It's time to position yourself directly in its path. Let's start the analysis and uncover the first of the three cities you cannot afford to ignore in 2026. This is where the patient buyer wins big. The first city on our exclusive list, the city where the foundations of sustainable 2026 growth are already cemented, is Cleveland, Ohio. Now, before you dismiss this, before you default to the outdated, toxic narrative of the Rust Belt, understand that this is exactly the kind of psychological barrier that creates the massive opportunity we are seeking. The market has a long memory for failure, but a short one for current success. While speculators were chasing the dazzling, fragile hype of Phoenix and Austin, Cleveland was quietly positioning itself as a geopolitical and industrial powerhouse for the next century, backed not by remote work fantasies or short-term rental bubbles, but by trillions of dollars in federal and corporate investment. This is the difference between speculative growth and foundational growth. The Cleveland-Akron metropolitan area is perfectly placed to capture the national reshoring movement, the massive, deliberate shift of manufacturing, biotech, and high-tech supply chains back onto American soil. This is not a guess, it is a policy-driven certainty. The CHIPS and Science Act, the Infrastructure Investment and Jobs Act, these aren't just headlines, they are direct pipelines of capital flow into key strategic regions. And the Northeast Ohio corridor, with its legacy manufacturing base, deep labor pool, and crucial freshwater access, is a prime beneficiary. Contrast this with the collapsing markets of the West and Southwest. They were dependent on a finite resource, cheap land and cheap money. Cleveland is capitalizing on an infinite resource, geopolitical necessity. As global supply chains fracture, the need for reliable domestic production of everything from semiconductors to electric vehicle components becomes paramount, and Cleveland is raising its hand. The core of Cleveland's immediate explosive advantage for the 2026 buyer lies in three distinct areas that directly solve the problems that crushed the 2025 boom markets. First, the cost of ownership is uninflated and stable. While homeowners in Florida and California are being choked by annual insurance premiums soaring to $6,000 or more due to climate risk, Cleveland's insurance costs remain remarkably low and stable. Its property tax rates, while regionally average, are offset by housing prices that have maintained the fundamentally sane relationship with local income. As of the end of 2025, the median home price in the Cleveland metro remained roughly $205,000. Contrast that with the $510,000 peak in Phoenix. A $205,000 home, even at a 7% mortgage rate, demands a payment that is supportable by the median household income. The math works, and that sanity is Cleveland's invisible shield against the national affordability crisis. Second, job market resilience is built on real industry. The largest employers here are not volatile tech startups or tourism ventures. They are world-class institutions like the Cleveland Clinic, university hospitals, and Case Western University, complemented by massive manufacturing and logistics operations. The health and education sectors, known as EDS and MEDS, are inherently recession-resistant. They do not get relocated overseas. They cannot be replaced by AI. They are constant magnets for high-wage, specialized labor. This stability guarantees a reliable, non-speculative demand floor for housing, protecting buyers from the sharp, sudden drops that crushed tech-dependent Denver. But the real game changer is the industrial rebirth. Massive corporate expansions are underway, particularly in biotech and advanced manufacturing, directly tied to federal initiatives. These are not low-wage jobs. They are mid to high-wage technical and engineering roles that attract a new, younger demographic, the exact professionals who fled overpriced coastal markets during the pandemic and are now seeking permanence. Third, municipal incentives for primary residents. Unlike the crash markets that became playgrounds for institutional investors and short-term rental operators, leading to saturation and eventual collapse, Cleveland is actively incentivizing stable ownership. Specific areas are offering tax abatement programs for new construction or significant renovation, sometimes freezing property taxes on the value of the improvements for up to 15 years. This is a deliberate, powerful strategy designed to attract and stabilize neighborhoods, directly counteracting the investor liquidation cycle that destroyed markets like Las Vegas and Sacramento. These incentives create an immediate, quantifiable ROI for the buyer that far exceeds any speculative gains in a volatile market. The city is essentially paying you to restore equity and live there. This is a quiet, powerful psychological trigger for capital, a calculated return with reduced downside risk. The opportunity in Cleveland is not in the headline-grabbing downtown towers. It is in the resilient, transitioning suburban and inner-ring neighborhoods that sit directly in the path of the new employment hubs. These areas still offer homes below the national average, but are about to see a wave of professionals who need to shorten their commutes to the expanding medical and manufacturing campuses. When the Wall Street money that fled Phoenix realizes the predictable stability and policy-backed growth potential here, it will move fast, quickly closing the affordability gap that exists today. Your window for this type of value acquisition is short, likely closing by the middle of 2026, as national media finally catches up to the story. This is the definition of striking when the market is still distracted by the wreckage elsewhere. The time of panic is over. The time of calculated action in a fundamentally sane, policy-backed market like Cleveland has just begun. We need to be prepared for the next wave of capital migration. We pivot now from the industrial resilience of the East to the anchored stability of the American heartland. If Cleveland's appeal is the massive, policy-driven industrial renaissance, our second city's appeal is the absolute, unflappable foundational economy that makes it almost recession-proof. It is the antithesis of the speculative bubble, a market built not on venture capital hype or fleeting remote worker migration, but on multi-generational Fortune 500 stability. The city is Omaha, Nebraska. Now, for the coastal audiences or those caught up in the Sun Belt's dramatic headlines, Omaha may seem like an unconventional choice. This is, once again, the psychological barrier we must dismantle. Real estate success in 2026 demands that you ignore the flashy narratives and invest where economic reality is strongest. While Phoenix, Dallas, and Tampa were experiencing catastrophic 50% swings in inventory and 20% price declines, Omaha maintained its notoriously stable yet quietly appreciating value. Its market never surged uncontrollably during the boom, meaning it has virtually nothing to correct during the bust. This is its core strength. Omaha represents the ultimate anchor city model. Its economy is dominated by sectors that require massive physical infrastructure and human capital, making them immobile and dependable. It is the headquarters for 4 Fortune 500 companies, most notably Berkshire Hathaway, whose influence extends far beyond finance, embedding a culture of fiscal conservatism and deep, long-term stability into the entire regional economy. Union Pacific, Mutual of Omaha, and the presence of Offutt Air Force Base, a massive, non-cyclical federal employer, form an economic bedrock that cannot be shaken by the layoff cycles currently ravaging tech-heavy markets. When people ask, what happens to the housing market if the economy slows down? In Omaha, the answer is very little. The jobs don't leave. This stability translates directly into housing market resilience. For the 2026 buyer, this means your investment is protected by a demand floor guaranteed by high-wage, diversified corporate and government employment. The median home price in the Omaha metro area has historically tracked closely with local wage growth, avoiding the dangerous decoupling that led to the collapses we saw in the Sunbelt. While other cities saw home prices skyrocket 80% beyond what local incomes could support, Omaha's steady 5 to 8% annual appreciation during the same period was fueled by genuine, organic population and job growth, making it one of the healthiest, most boring markets in the country. And boring, in this housing environment, is the new gold standard. The primary investment thesis for Omaha in 2026 rests on two unique, time-sensitive factors. First, the urban core renaissance and infrastructure magnetism. For decades, growth was a steady march westward, expanding into suburbs like Papillion and Gretna, which are themselves now reaching maturation. This westward expansion created a massive, well-developed suburban inventory, which has historically kept prices stable. However, the focus has abruptly shifted back to the urban core. Massive infrastructure projects, including a multi-million-dollar riverfront park renovation and the development of a modern streetcar line, are dramatically enhancing the desirability and accessibility of central Omaha neighborhoods and those immediately surrounding it, such as Blackstone and the Medical Center area, UNMC. Retail development, which always follows roof shops, is now aggressively moving into these newly revitalized central corridors, indicating deep investor confidence in the long-term residential viability of the downtown area. This pattern, suburban saturation pushing demand and capital back to a newly improved, affordable urban core, is the blueprint for explosive, non-speculative appreciation. The early buyers who recognize this re-centralization trend and invest near the new streetcar line or the riverfront development will capture a generational leap in home value, as the city essentially creates a new premium location where none existed before. Second, the affordability gap. It's closing. The data shows that the rental market in Omaha is exceptionally tight for mid-market and workforce housing, with vacancy rates hovering around 5.5% or lower. This robust rental demand is a powerful indicator of suppressed home ownership demand. It signals a deep pool of qualified, employed renters who are being held back only by high national mortgage rates. As the national rate environment eases slightly in 2026, as predicted by most major economists, and mortgage rates drift towards the low to mid 6% range, the sheer volume of pent-up, income-qualified Omaha buyers will be released into the market. Because Omaha's inventory has historically been constrained and its builders have practiced restraint, unlike the overbuilding glut that afflicted Phoenix, this sudden injection of demand will meet insufficient supply. The result is a sharp, immediate appreciation in home values, transforming the current steady market into a surging market. Omaha is a buy because it is fundamentally stable, strategically positioned for infrastructure-led appreciation, and sits atop a powder keg of pent-up demand. It is the market that makes sense when chaos reigns elsewhere. We are buying stability, and in 2026, stability is the most valuable commodity. We have analyzed the industrial resurgence of Cleveland and the anchor stability of Omaha. Now we turn to the final and perhaps most overlooked opportunity: the policy magnet city. Our third and final city is the policy magnet, a market quietly engineered for stable growth by forward-thinking municipal and state governance. It is Raleigh, North Carolina, and its surrounding Research Triangle area. Raleigh represents the sophisticated buyer's choice, combining the high-wage employment base of a major tech hub with the foundational stability of world-class universities, yet maintaining a balanced inventory and cost of ownership advantage over its East Coast rivals like DC and Boston. Unlike the speculative tech bubbles that crashed in the West, Raleigh's growth is anchored by three massive immobile institutions: Duke University, UNC Chapel Hill, and North Carolina State University, collectively forming the Research Triangle Park, RTP. This academic triangle ensures a constant pipeline of high-skilled labor and attracts billions in non-cyclical grant-funded research and development. The job stability here is exceptional, focused on biotech, pharmaceuticals, and specialized software development, sectors largely immune to the mass layoffs that plagued Silicon Valley. The compelling opportunity for 2026 buyers lies in the policy differentiation regarding taxes and incentives. North Carolina has been highly aggressive in attracting corporate headquarters and manufacturing facilities with favorable corporate tax policies, directly increasing the high-wage employment base. More critically, while property taxes are rising nationally, the Raleigh area maintains a tax-to-income ratio that is manageable, making the total cost of ownership, mortgage plus taxes plus insurance, highly affordable relative to the income earned. Furthermore, the inventory issue, the central killer of affordability in the prior boom, is being proactively managed. Builders, having learned lessons from the oversupply crises elsewhere, are ramping up strategically in the outer rings, like Johnston and Chatham counties, creating a steady, balanced supply that prevents the market from both exploding into a bubble or collapsing into an overbuilt glut. The final decisive advantage: the migration influx is resilient and high quality. The capital and talent that is fleeing the punitive tax and cost environments of the Northeast, New York, New Jersey, and the volatility of South Florida are finding Raleigh the logical, balanced endpoint. These are often high net worth individuals and professionals who transfer equity and high-paying remote jobs, injecting immediate sustainable wealth into the local economy. This is a demographic that will not vanish when rates rise slightly. The confluence of resilient, high-wage jobs, steady inventory growth, and favorable tax policy makes Raleigh the most dependable investment on the East Coast for the 2026 buyer. It's not a speculative bet, it's an institutional-grade investment that the informed buyer can execute today.